Artificial intelligence is integrating into the global workforce, shifting task exposures across thousands of occupations. But while the economic outputs are highly visible, the industrial architecture producing these models is fiercely debated. When we discuss monopolies, we usually picture a dominant corporation crushing competition through market manipulation or exclusionary business practices. But a natural monopoly is different. It occurs when a single firm serves an entire market at a lower total cost than multiple competing firms. Historically, this happens in industries requiring heavy physical infrastructure, where the upfront capital, like laying miles of steel track or building a power grid, naturally limits the market to a single provider. The scale of modern AI requires a different infrastructure. Instead of steel and concrete, capital is poured into sprawling, centralized GPU compute clusters. This raises a critical economic question. Does the mathematical reality of training artificial intelligence dictate that the industry must operate as a natural monopoly? When we apply rigorous economic criteria to the AI tech stack, the data suggests that pre-trained foundation models exhibit the defining characteristics of a natural monopoly. This creates an immediate regulatory paradox. Despite this structural concentration, deploying traditional policy responses, like utility-style pricing or forced corporate unbundling, does not currently align with market outcomes. This disconnect stems from a mismatch between the industry's structure and its current behavior. The standard indicators of monopoly harm, like artificial scarcity or price gouging, aren't immediately apparent in the pricing data or performance benchmarks. Applying heavy antitrust interventions to this specific, nascent market architecture risks destroying the innovation it seeks to protect. To evaluate whether an industry operates as a natural monopoly, we first have to draw rigid market boundaries to isolate the specific product in question. Look at this vertical diagram of the AI ecosystem. It separates a wide top layer of consumer-facing, fine-tuned applications from a much narrower foundational layer of underlying models. We are excluding fine-tuned applications, like chatbots or medical imaging software, from this analysis. Those markets have low barriers to entry and produce highly differentiated products, meaning they easily support fierce competition. The focus of our economic test is strictly the bottom layer, the market for pre-trained foundation models operating at the technological frontier. Focusing on these raw, pre-trained models allows us to examine the massive upfront compute investments that actually determine market power and dictate the barriers for any new entrants. This matrix tracks the 5 criteria required for cost subadditivity. This is the mathematical threshold where one firm can produce a good for the entire market at a lower total cost than multiple firms combined. First, product homogeneity. At the direct API level, raw foundation models are highly substitutable. Developers choose between them largely based on raw benchmark performance and token pricing. Second, economies of scale. The fixed costs required to train a frontier model, encompassing specialized talent, hardware, and energy, are high, yet the variable cost of serving that trained model to an additional user is comparatively near zero. Third, sunk costs. The capital deployed to run a massive training cluster and acquire data cannot be recovered if the resulting model fails. This risk presents a significant deterrent to potential market entrants. Fourth, economies of scope. A single pre-trained model serves as a shared input that can be fine-tuned across completely distinct downstream product lines, simultaneously powering text, code, and image generation. Finally, network effects. While open-source models do benefit from community-led development loops, this acts as a moderate factor compared to the pressure of scale and sunk costs. Because the current pre-trained model market satisfies these 5 conditions, it successfully clears the threshold of cost subadditivity. Structurally, the status quo market operates as a natural monopoly today, but artificial intelligence is still a nascent technology. Its current concentration is dependent on present-day praction methods, making it susceptible to technological shifts. This grid tracks the 2 technological variables that will dictate the market structure by 2027, the future cost of compute and the longevity of the scaling hypothesis. The scaling hypothesis is the theory that feeding a model exponentially more compute power and data will predictably yield linearly better performance. If we look at this top right quadrant, where the scaling hypothesis holds and compute costs remain high, sunk costs and scale economies will compound. This would lock the market into a strict, enduring monopoly. Conversely, in these opposing quadrants, the scenario flips. If large models hit diminishing returns and scaling fails, or if algorithmic breakthroughs lower training costs, the massive financial barrier to entry collapses. Without that barrier, the industry fractures, transitioning from a strict monopoly into a looser oligopoly or monopolistic competition. The ultimate concentration of the AI industry will not be determined by corporate strategy alone, but by the physical limits of hardware and the mathematical boundaries of scaling. The production data classifies the current foundation model market as a natural monopoly, but structural classification is only the first step for economic policymakers. The historical government response to a natural monopoly is to implement utility-style regulation. This involves deploying strict price controls or heavily restricting market entry to protect consumers. But there is a disconnect. Utility regulation exists to prevent specific social costs, such as monopolists pricing products above marginal cost or delivering low product quality. Right now, those specific harms are absent from the AI market. The observable realities of the market contradict textbook monopoly behavior. Incumbent firms are aggressively competing on benchmark performance, and the proliferation of open-source models is constantly forcing API pricing downward. The massive concentration of capital and infrastructure is currently delivering substantial consumer welfare. We are witnessing an economic paradox, a structural natural monopoly that is functioning like a competitive market. This chart highlights the friction between the high-frequency release cycles of foundation models and the slow-moving timeline of traditional regulatory frameworks. Implementing static rules on a tech stack where the underlying cost structure and performance limits shift every few months invites severe regulatory mismatch. It risks Type 1 regulatory errors, where preemptive intervention throttles innovation before it can mature. Policymakers must separate the structural classification of the AI market from its actual behavioral output. The trigger condition for government intervention must be precise. Regulators should only act if they observe measurable negative welfare effects, such as coordinated price gouging or artificial product stagnation. The AI foundation model market mathematically meets the criteria for a natural monopoly, but until those structural traits lead to actual consumer harm, imposing static utility regulations on shifting compute architectures will likely dismantle the very innovation it aims to protect.